Hello friends, so welcome back to Fab Classes, and now in this video we are moving towards illustration number 2 from the investment accounts chapter. So the difference between illustration number 1 and illustration number 2, I'm sorry, I did not keep the mic, 1 second. Okay, so the difference between illustration number 1 and illustration number 2 is that illustration 1 was relating to a fixed interest bearing security. That means those securities which have a fixed amount of interest, that is debentures. But now in case of illustration 2, the investment which we are going to make is in a shares. Shares are not a fixed interest bearing security. The returns which we are getting from shares is dividend, and that dividend is not fixed. We don't know when we are going to get dividend and how much dividend we are going to get. So that is the basic difference between illustration 1 and illustration 2. So let's see how we are going to solve this illustration number 2. On 1/4/2011, Mr. Krishnamurthy purchased 1000 equity shares of rupees 100 each in Telco Limited at 120 each from a broker who charged 2% brokerage. He incurred 50 paise per rupees 100 as cost of shares of transfer of stamps. So the cost of shares will include this purchase price 120 and the broker charge, purchase related expense 2%, and also another purchase related expense which is 50 paise per rupees 100 as cost of shares transfer stamps. And on 31/1/2012, bonus was declared in the ratio of 1:2. So 1:2 in the sense 1 share for every 2 shares held. That is, for every 2 share he has got a bonus of 1 share. And before and after the record date of bonus shares, the shares were quoted at 175 per share and 90 per share respectively. On 31/3/2012, Mr. Krishnamurthy sold bonus shares to a broker who charged 2% brokerage. So these shares, the bonus shares which we got was sold, and there was a brokerage of 2% also. And now show the investment accounts in the books of Mr. Krishnamurthy, who held the shares as current assets, and the closing value of the investment shall be made at cost or market value, whichever is lower. So we are required to prepare an investment account. So let's see how to prepare this. The basic format is same as in case of illustration number 1. In the books of Mr. Krishnamurthy, and the investment is in the shares of Telco Limited, we are preparing the investment accounts. Date, particulars, quantity, and here in illustration number 1, or in case of fixed interest bearing securities, it is interest, and here it is not a fixed interest bearing security, and the returns which we are getting from shares is dividend. So here we are recording the dividend, and once we get the dividend, we will fill the dividend column. Once we earn the dividend, once the company declares the dividend, and once we get the dividend, we will be filling this column. Otherwise this column will be empty. So quantity, dividend, amount, quantity, date, particulars, quantity, dividend, and amount. So this is the basic format. Now let's start solving the question. So the first thing, on 1/4/2011, Mr. Krishnamurthy purchased 1000 equity shares. So purchase in the sense asset. Investment is an asset. So investment is being purchased. So investment account debit to bank account. Investment account debit to bank account. On 1/4/2011, I think. So to bank, 1000 equity shares. The dividend column will be empty because there is no declaration of dividend at the time of purchase. Now we have to find the cost of this purchase. For that purpose, we have to prepare a working note. Okay, so let's prepare a working note. Working note number 1. Cost of shares. So the purchase price is 120 per share. So the cost will be 120 into 100, 1,20,000. Along with that, we have also paid a brokerage. Brokerage at what rate? Let's see. From a broker who charged 2% brokerage. Okay, so brokerage at 2% of 1,20,000. 1,20,000, which will be into 2% in the sense 2,400, and also 50 paise per rupee 100 as share transfer stamp. That means share transfer stamp. Cost of share transfer stamp. So it is 50 paise per rupee 100. So how much it will be for 1,20,000 rupees? So we can do a cross multiplication. 1,20,000 into 0.5 divided by 100 into 0.5 divided by 100, that is 600. So the value will be 1,23,000 will be the cost of purchase. So now let's fill that. So 1000 shares was purchased for 1,23,000. I hope it's clear. And now on 31/1/2012, bonus was declared in the ratio of 1:2. That is 1 share for every 2 shares held. So let's see how to record this. Once we purchase the shares, we know that the entry is investment to bank or shares to bank. However, in this case, shares are coming in, investments are coming in, new shares are getting in, but money is not going out. So shares will be debited, but to bank will not come because money is not going out. So the thing which we will record is to bonus. The shares are coming by way of bonus on 31/1/2011. This was 1/4/2011 on 31/1/2012. So to bonus shares are coming, but we don't know how much shares are going to come. For that purpose, we are again preparing the working note. Working note number 2. Bonus ratio. The bonus ratio is 1:2. 1 for every 2 shares held. That means how much for the 1000 shares held. We have 1000 shares in our hands. So if 1 share for every 2 share held, then how much for every 1000 share held? So we will be doing a cross multiplication, and the value is 1000 into 1/2, 500. 500 is the number of shares which we are receiving through bonus. So let's record that. 500 shares we are going to get. There is no declaration of dividend, so this column will be empty. And what will be the cost of purchase? That will also be nil because we have not paid any amount for this bonus shares, right? So this is all. Let's see what happens next. Before and after the record date of bonus shares, the shares recorded at 175 per share and 90 per share respectively. The value of shares is given. And on 31/3/2012, Mr. Krishnamurthy sold bonus shares to a broker who charged 2% brokerage. Okay, so these shares were sold to the broker. So the shares will be sold at this price, right? This is the value of the shares after the issue of bonus shares. So the sale price will be, let's see, we have to record the entry of sales. So sales entry will be money coming in and shares going out, and the date is 31/3/2012. Okay, so now we are recording the entry of sales 31/3/2012 by bank. By bank, the bonus shares are being sold, so 500 shares are being sold. There is no declaration of dividend, and now we have to find what is the selling price. So for that purpose, again, working note. Okay, working note number 3. Sale price is 500 into 90, that will be 45,000, right? This will be the price, and along with that, from this sales price, this will be the value which we are getting through sales. From that, we are paying a brokerage at 2%. We have to pay. A selling expense has been incurred, the brokerage of 2%, so that we have to deduct from the selling price, and the net sales will be 2% of 45,000, right? So 45,000 into 2%, in the sense 900 will be reduced, so the net sales will be 44,100. This will be the net sales or the net sales value which we are going to get. So this is the price which we are going to record here, 44,100. And now while doing the sales, we will be getting some profit, right? So for that purpose, we have to find out how much is the profit which we are getting from this sales. So that is the next point. So once we have recorded the purchase entry and we have received the bonus shares, we have also recorded that, and after that we have done the sales, and now during the sales we will be getting some profit, and now we have to calculate how much is the profit which we are getting through these sales. So that is the working note number 4. For that purpose, we know the sales value will be cost plus profit, right? So in order to understand how much is the profit, the profit value is sales minus cost. So we know the sales value, that is 44,100, but we don't know the cost of this 500 shares, right? So we have to find how much is the cost of this 500 shares. So for that purpose, what we are doing is, for 1500 shares, I mean these, we had 1000 shares in our hands and later on 500 shares. So in totality we had 1500 shares in our hands. For 1500 shares, the cost which was incurred was only 1,23,000. So for 1500 shares, the cost was 1,23,000. It's in that case, for 500 shares, what will be the cost? This is the way we find out the cost of the bonus shares. For 1500, the cost was 1,23,000. So for 500, how much? Do a cross multiplication and you will get the answer. 1,23,000 into 500 divided by 1500. 41,000 is the cost of these 500 shares. I hope you understood. So 41,000 is the cost. Thus the profit which we have incurred from the sale of this 500 shares will be 44,100 is the sales value which we have received. Once again, 44,100 is the sales value which we have received and the cost was 41,000. So the profit will be 3,100. This profit will be shown in the profit and loss account. This profit will be transferred to the profit and loss account. Okay, 3,100 profit. I hope you get it. So now on 31/3/2012, right? On 31/3/2012, to profit and loss account, 3,100 will be shown. Okay, so now we have sold this and now the balancing figure. We have to find out the balancing figure at the here end. By balance brought down. By balance brought down, the quantity will be 1000. So 1500. 1500. There is no information relating to the declaration of dividend. So there will be no declaration of dividend. So nil. And now we have to find out the cost of this 1000 shares. We know that the value of these 1000 shares, the market value of these 1000 shares is 90, because after the issue of the bonus shares, the value of shares have become 90. So the market value is 90 and we have to find out how much is the cost, because here it is clearly specified that the closing value shall be recorded at cost or market value. So we have to find out the market value also, the cost also. So the market value, it is very simple. We know they have directly given that. This is working on number 5. So they have directly given the market value is 90. So for 1000 shares, the market value will be 90,000. And in case of cost, similar to the way how we have found the cost of the bonus shares, the same way we have to find the cost of these 1000 share also. For 1500 shares, the cost was 1,23,000. And now for 1000 shares, what will be the cost? This is the way how we find the cost of these balancing shares. So do a cross multiplication and you will get the answer. 1,23,000 into 1000 divided by 1500 and the answer is 82,000. So the closing stock will be valued at cost or market value, whichever is less. So what is less here? 82,000. So the closing stock will be valued at 82,000. 82,000. Okay, so now we have to balance this amount column also. So the procedure is, first we recorded the purchase entry, then we recorded the bonus entry, and after that, while doing the sales, a hidden adjustment is there, that is we have to record the profit from the sales, and after that we will be recording the closing value, I mean the closing balancing figure. And in that case we are checking whether the cost of the investment or market value, which one is less, and we are recording the cost at cost or market value, whichever is less. Okay, and now we are balancing this, and whatever balancing figure, it will go to the profit and loss account as the profit or loss from the investments. So 1,23,000 plus 1,26,100, this will be the greater side, I think. Let's see, 4,400 plus 82,000 gives 1,26,100. So there is nothing as balancing figure. So the figure is balanced. So this is all about illustration number 2. I hope you understood this problem. If there is any doubt, there are many more illustrations to go. Please do have a look at all the illustrations, then every problem of yours will be cleared. And in case if you have any doubt relating to the concept of the investment account, I have already uploaded a video relating to that also. So please do have a look at it. So that's all for today. Thank you so much. Bye.